Checking. Okay, seems like the mics are working well. So yeah, let me know if you guys hear it well on your end. Like I know we just heard it on our end. Let me know if you guys hear the mics on your end. If so, then we can move forward and we can talk about some good stuff this morning. So, all right, yeah. So yeah, good morning, Oliver. Good morning, Chris. Good morning, Stuart. Yeah, good morning, Joe. Thanks for coming. Good morning, Rob. Everything sounds good. That is great and that is excellent because I know today is going to be a special day for you guys. What we're going to do is reveal some good stuff for you guys. And what I want you guys to do is just take notes. I think you guys will be, pretty happy with some of the stuff we're going to reveal today. But we're going to focus more on technical analysis for today. But let me make sure this chart is set up okay. Let me make this full screen. And all right. Okay. Yeah. So then, we have quite a bit to cover. I'm not going to hold you guys hostage for too long. But what I do want to reveal to you guys is a way that you can approach your trading from here on out. And if you apply this even on our next week, you should do well. You should do fine. Our job is to show you guys how to trade the right way. So then that's our job and that's our duty. And we're going to give you some stuff today that will help you make some decent money this year. And this is really basics, really. This is a simple strategy, but it works and it works really, really well. So, of course, this is just the tip of the iceberg from some of the stuff we're going to reveal to you guys in the months and weeks to come. But I think you guys will be pretty happy with some of the stuff we're going to share today. And it's based on a lot of the information that you already know. If you went through the video tutorials or if you've been on our back to the basics sessions, then you would know some of this information. Now it's time to piece everything together. But before we move forward, what I want to throw out there is this whole idea of technical analysis. So let me, I guess our job is to help define it for you. But does anyone know or have an idea of what technical analysis is? Just that term, technical analysis. Like, what is it? And if you can just have a simple description of it, what do you think that is? Technical analysis. And I know a lot of people have different definitions, but I'm pretty sure they all reveal the same really result or the same outcome of what we expect to get. Okay, so then Joe said analyzing the charts. Stuart said reading the price charts. Both definitions are really, really good. But yeah, analyzing the charts, price charts, reading the price charts. Okay. So yeah, to some degree, that is what technical analysis is. If you want to boil it, bring it down to a simple definition, is analyzing the charts, reading the price charts. I know Ryan said looking at the charts to hypothesize what price will do. And that's a good definition, really. It really is. Because we're sort of anticipating what price will potentially do. But Adam said finding support and resistance. That's good. Yeah. So then all of those definitions are great and they're excellent. And they sort of give an idea of what technical analysis is. But when you look at these price charts, what are you really seeing? That's the one question you have to ask yourself. Like, what are you really seeing? And what we're really seeing is, well, I was going to give you guys the answer, but I want to ask you guys, when we see price move up and down, up and down, up and down in this fashion, in this chaotic, random fashion at times, what are we really seeing? Okay, Richard said versus from who is in control. Yep, exactly. Okay, so then that is what we're seeing. We're seeing who's in control, where market forces are. But if you just simplify it to its, okay, yeah, okay. Joe said we're seeing buyers and sellers. We're seeing the activity of buyers and sellers. We're getting close. Buyers and sellers moving price. Okay, yeah. So then that is what we're seeing. We're seeing buyers and sellers moving price. We see who's in control based on where price is trending. We see all of that. But I guess we can just really break it down. Okay, so then let me ask you guys this question. What are the two emotions that govern people's actions when it comes to the financial markets? You know, there's two dominant emotions that governs most players' activity or actions in the market. Okay, yeah. So Stuart said fear and greed, fear and greed. You know, Joe said FOMO, which is fear of missing out. But yeah, you guys are correct. It's fear and greed. And we all know that fear and greed is
a motivator.
It's a motivator. It's part of it's a behavior. It's a part of human behavior. So then what you're seeing is really a plotting, like on these charts, you're seeing a plotting of human behavior, and that human behavior is governed by either fear or greed. Fear or greed is what's creating this price behavior on this chart. Price behavior is synonymous with human behavior when it comes to the charts. So then what you're really determining is what a group or herd of humans that are participating in the market are doing at a particular set time, and you're forecasting it, what they're doing based on previous behavior
and price data
and data and patterns that you see in the market.
Yeah. So really, in a nutshell, like, good morning, everyone. This is me, Marvin. But what you really, like, in a nutshell, what technical analysis is that you're looking at previous price data, previous data on the market's volume, looking at various indicators to sort of get an understanding of the crowd behavior. Like, what is the behavior of the overall market, or what are like, you study past behavioral patterns to sort of get an idea of what
potential future behavior or patterns will be.
Yeah, exactly. Future behavior, future price patterns. So then what technical analysis is primarily like what everybody said. We're studying the chart data. We're studying previous statistical data, historical data in price behavior to sort of get an idea of how the market is behaving, how the market responds to, or is motivated by fear and greed to sort of speculate what prices would do in the future, or what that particular asset or security would do in the future. So then it's mostly, of course, technical, it's statistical, but we're still measuring human behavior. So then all of our trades, all of our trading decisions is based on that herd mentality, because most human behavior, like most of us humans, respond in a simpler type of behavior. Like when something happens, like most humans have a similar type of reaction or response.
Well, yeah, and they're predictive in nature. And that's one thing that a lot of people that study the charts, like chartists and even psychologists that's involved in trading, what they understand is that human behavior at times can be very predictable. And all you have to do is look at what they've done in the past to sort of predict what they could potentially do in the future. So then I know Richard said big bank activity, and they play a major part as well. You know, big banks provide the liquidity that we need in order to push price in a particular direction. And at times they could push price in a particular direction. But guess who is going to respond to the actions of the banks? Humans. Humans are going to respond, and they're going to do something. They're going to respond and react to whatever the banks are doing. So then when it's all said and done, what you're really seeing is really a plotting of human behavior. You know, oftentimes when you see price really go in a particular direction, you see that herd mentality. You see people jumping in and they following because of fear of missing out or greed. Those behaviors usually govern how far price could potentially move in a particular asset. But, you know, that's it in a nutshell. That's all technical analysis is looking at prior data, prior price patterns to sort of anticipate or forecast what could potentially happen in the future. So it's not predictive, it's not gambling or guessing. You are using information in order to support your hypothesis, just like Ryan said, or your theory of what price will potentially do. And if you do it right, if you gather your data and your intel properly and you make a decision based on prior data and prior price history, then you'll find yourself being right more times than wrong. And we're going to reveal that to you guys on today's session.
Yeah.
But then that's the basis and crux of technical analysis in a nutshell.
Yeah. And it's, and it's rule based, which means there's certain rules that are in place. And also there's certain technical tools we use to sort of help in our technical analysis, which we will be, discussing and covering today. So then, one thing you have to realize is that it's based on a rule based method or system of analyzing price behavior, analyzing our chart to really get an idea of the market's response, market's behavior, and to sort of anticipate what the market would do moving forward. So then it is technical. It utilizes certain tools, and it's a rule-based method of analysis.
Yeah. So then when we use technical analysis, just like Marvin said, we look at our most important indicator, which is what? Like, how many guys remember that? Like, what is the most important indicator that we use as a trader? The most important indicator is what? For those who do know, then they can just chime in, if they do remember what that is. Okay, so then Adam said price. And does anyone else want to chime in? But I guess for the sake of time, since we don't have too much time left, but yes, he's correct. The most important indicator on our chart is price itself. Price is the most valuable indicator on your chart. What price has done historically, how price is moving, the volume, the speed of price, that reveals to you what price could potentially do in the future. So then that's the reason why it's your most important indicator. But then in addition to price, there's other indicators that we could use as well. So then I know on today we're going to introduce to you guys at least 2 indicators that you can use. And I know some of you guys already know these indicators, especially if you've been looking at the videos. We do briefly mention these particular indicators, but the first one we're going to look at is the 20 simple moving average. We're going to look at that right now. So then let us just add that right now. And we're not going to be too long on this particular indicator because it's pretty simple. It just reveals just a few things we need to be mindful of when trading these markets. So then what we're going to do is introduce to you guys the 20 simple moving average. So what we're going to do is right now we're on TradingView, and we're going to add this indicator to our chart, the 20 simple moving average. What you could do is go to this section that says indicators up here, indicators and strategies, but we'll click on this button that says indicators at the top. And then from there, what we're going to do is select moving average. We're going to scroll down this list where it says this built-ins category. We're going to scroll down, and then we're going to select moving average. Okay, and then we're going to click on OK. And then what we're going to do is change the parameters of this moving average. What we can do from here is, of course, we can click on this moving average, and then to the upper left, you'll see this gear icon. You'll see the moving average. Right now, set to 9. But what we want to do is change the parameters. So we click the settings or this gear icon, and from there we can change it. Let's change the inputs first.
Yeah. I first wanted to point out, because I know he didn't mention it, that once we added that indicator, you saw this line plotted on your chart that went along with the course of the price behavior. So then you see this blue line here, and right now we have it at a length or a period of 9, but he's going to change it. And we're going to actually define what that is in a little bit, what this number is. But we want a 20 simple moving average, which means that this moving average is going to be priced based on the past 20 periods.
Yep. So so then we added 20 as our input, as our length. And then from there, what we want to do next is we can go to style. If you want to, you can change the color if you want. We could make this, let's just make this this color right here, and let's increase the thickness for the sake of this presentation. Let's make it pretty thick, and then from there, have it like this. Okay. So right here, we have the 20 simple moving average plotted. And what this indicator is, or what it means is this, is that what it does, it takes the average closing price of the past 20 candles. So then that's the reason why we have 20. It takes the average closing price of the past 20 candles, and what it does out of those past 20 candles, it calculates the average, like an average price out of those 20 candles. And what you see is a plotting of that value for each hour. So then pretty much in a nutshell, what it is just getting an average of price over the past 20 candles. That's really what it is in a nutshell. So then we see that this 20 moving average line follows price pretty closely. You can see that, when price goes down, the 20 moving average is going down and sloping down. When price starts to go up, the 20 simple moving average is starting to go up and slope up. So then what it tells us is just an easier way to define where price is headed, or the momentum of price. It's just an easy way to define it, a simple way. So then that's pretty much what it is. Now, let me describe how to use it. Now, there's two ways that we use it. For one, we can use it as a filter of what side of the market we need to be on. And let me just maybe
even directionality.
Yeah, and directionality. So then let me just share with you guys what I mean. Whenever price is above the 20 simple moving average and it's sloping upwards, then you really want to be looking for opportunities to buy. In a nutshell, that's what you really want to do. You want to look for opportunities to buy. But when it's below the 20 simple moving average and when the moving average is sloping downwards, then you want to really look for opportunities to sell. So then that's just a simple approach or simple way you could look at the 20 simple moving average. When price is below the moving average line, the 20 simple moving average, and that 20 simple moving average is sloping downwards, then you primarily want to look for sell opportunities. So then let me just write that down up here. This is just pretty simple. This is just really, really simple stuff. But let's just do, okay, so we 20 simple moving average. When it's, if it's, let me increase this a little bit. So 20 simple moving average, if it's sloping down and price is below it,
or the instrument or asset, however you want to define it, is below the 20 simple moving average,
then this is when you want to look for opportunities to sell.
Yeah.
You're primarily looking for opportunities to sell. But when the 20 simple moving average when the 20 simple moving average is sloping upward and price is above, you primarily want to look for opportunities to buy, right? So then that's how you would use it. It's pretty much could be used as a filter of what you should be doing, what you shouldn't be doing at a particular set of time. Now, you don't really have to use this strategy. I'm gonna use this indicator if you don't want to, because I know on the strategy that we're going to show you guys don't really have to pay too much attention to the 20 simple moving average, but for the most part it does help you. If you need a way to refine whether or not you buy or sell, like a filter that you can have in place, then the 20 simple moving average is a good filter to have. But in addition to that, 20 simple moving average can also be used as some movers can also be used as dynamic support and resistance. Yeah, and we'll probably talk about that a little bit later. But this is the way we use the 20 simple moving average. We got to look whether price is below it and whether it's sloping downwards. If so, we want to stay on the side of selling. When price is above the 20 simple moving average and it's sloping upwards, then we want to stay on the side of buying. And also what we could use the 20 simple moving average is as, we could use it as dynamic support and resistance. In other words, price will oftentimes test or touch the 20 simple moving average, and then you'll see price respond and react to that level, or or within that vicinity. So you'll typically see that happen, and we'll show you an example on this chart.
Yeah. And you can also, this isn't really important, but you can also use the 20 simple moving average in like comparison data, or when you're trying to compare or assess the 20 simple moving average in relationship with another technical indicator, or in relationship to price or some other type of indicator. So then you can use it in certain types of comparison data, but that's not really the most important. Like that, that's adding more to your play, and we may discuss that further along when we get to more advanced topics. But for the most part, we use it to identify market direction, market bias, but to also as possible support and resistance, and dynamic support and resistance. And the reason why it's dynamic, because it changes with time. It's not stationary, it's not static, those support and resistance levels, but the 20 simple moving average changes with time.
Yeah, so then moves and changes with time.
So then so that the support and resistance level and price point is going to be different as time progresses. So then that's the reason why it's dynamic. But yeah, you can use the 20 simple moving average in those ways, and it's a pretty good indicator. It's one of the most important indicators to plot on your chart.
Yeah, it's one of the most important ones. So then that's the reason why we introduced it second. But let's just look at these charts right now. So then we see right here that price was in consolidation, but you see that it was pretty much flat for the most part. Price wasn't going up or wasn't going down. But as soon as
oscillating,
it was oscillating. But as soon as we get a break of this pattern or this consolidation to the downside, we see that the 20 simple moving average starts sloping to the downside. So it's pointing down. It's sloping to the downside, which means that you should be looking for opportunities to sell. Whenever you see it sloping downwards, it's like a finger pointing down saying, hey, you need to look for opportunities to sell. Price is going down. And the very fact that price is beneath it lets you know what side of the market to be on. You need to look for opportunities to sell. So it's pretty simple. So then in this case, when price is falling down, we don't need to be buying. We're going against the momentum of the market. The 20 simple moving average is telling you where the bias and directionality of the market is. So then in this case, we see it sloping down, price is beneath it. So then we do not want to buy. That's one thing we know. We're not going to buy in this scenario. We're going to look for opportunities to sell. So then that's what it pretty much reveals.
And I think, a common misconception that people have, especially for those that may have traded stocks, or you were taught that you want to buy on the down move, or you want to keep buying. We hear the term buy low, sell high, and sometimes we really don't understand that completely. But for some traders, they may feel like, well, it keeps going low and it's at a record low. It's been going low for a time. So price is going to eventually rotate higher because it's going to get exhausted. It's going to be oversold, and I can just go in and buy and keep a very wide stop and hope that eventually at some point the market would turn. And that's just a poor way of trading. You don't want to find yourself in a downward trend trying to catch a falling knife, and then you end up bleeding all over the place because the price keeps falling and falling and falling. You want to wait for clues and technical clues. And for one, the 20 simple moving average is showing you where momentum is. It's showing you that the momentum is to the downside, and you don't want to fight too much against the trend. You remember, the trend is your friend. Even though it's relative, that statement, that trading proverb is relative based on a few other things and subjective, but for the most part, that trading proverb is true, that the trend is your friend. Whatever the trend is, that's your friend, and you want to stay in good relationship with your friend. You want to stay in good, you want to stay like, you want to just, be on the side of your friends. You want to just stick with your friends. So then in this case, since the 20 simple moving average is sloping downward, we only want to sell until the market is giving us a clue otherwise, which if you look further on in your price chart, you'll see.
Yeah, so then I want to look at, so then in this example right now, we're selling. And then all of a sudden price gets above the 20 simple moving average. And what do we see happen? It starts to flatten out or starts to slope upwards. So then based on our simple moving average rules, remember, we want to sell when it's sloping down and when price is below it. And we want to buy when it's sloping upwards and price is above it. But in this case right here, do we want to be selling right now? Now, I know this is relative because you can see previous price history, but in this case right here, if we didn't have any data in front of us, no, we wouldn't be selling based on the 20 simple moving average. We wouldn't be selling at all. Like if we just did this replay tool right here, and we see this happening, we see the 20 simple moving average is sloping upwards, then we wouldn't really be selling right now if you're going to use the 20 simple moving average by itself.
As a rule.
As a rule, which you can. It may limit you. You may not get involved in some of your good trading decisions, but it could keep you from making bad decisions when momentum may be changing. Because we see that it's sloping or flattening out and price is above it. So then based on your rules above, we would not look for a sell. Right now we will be neutral and we'll wait for price to give us more clarity of what's going to happen. So then even if you look at your charts, okay, we see that price is now in this consolidation, but we see that it's starting to slope upwards now. So then that would keep you from from selling when you when you don't know what's going to happen.
Yeah, but this, but I was gonna say, but it shouldn't also cause you to buy either.
It shouldn't cause you to buy either, because you don't want to use the 20 simple moving average by itself. Remember, you have to look at price. Price is your most important indicator. Like reading the price chart, doing those exercises that we've done, and we're going to do that again today. That's one of the most important things you can do. So then right when price gets into this part, you're really in neutral phase. You're not selling, but you're not buying either. And we can see that price was trapped in this range. Now, as you see here, now price begins to break below. It's below the 20 simple moving average, and we're starting to see it slope to the downside now. Now, this is when we want to say, okay, now we need to look for a selling opportunity right now. Price is below the 20 simple moving average. It seems like it's starting to curl or cycle downwards. So then what we're going to do is look for an opportunity to sell. So then we're going to wait for price to give us that opportunity. Maybe it would happen right here. We see price test this 20 simple moving average right here. The 20 simple moving average is still sloping downwards. So then let's see what happens. This could be where we could enter a short. Boom. And you see that price starts falling downwards, right? Starts falling downwards from there. So then, this is just a way we can use the 20 simple moving average right here. Price is below it. Some moving average is sloping downwards. That means momentum is to the downside. We need to look for opportunities to sell. But yeah, that's just a pretty simple way to approach the markets, just from using the 20 simple moving average. But like I said, and like we both said, we don't want to exclusively use those rules of the 20 simple moving average by themselves, because if you do that, then you're going to find yourself oftentimes frustrated, because you're going to make decisions and it's not going to be in your best interest as far as a trader.
Yeah. But in the example that Melvin just pointed out, we saw price break to the downside, and then we saw this pullback in price into this area of consolidation. So then, of course, you always want to sell after a pullback or retracement in price. That's something we sort of introduced to you guys even earlier on.
Yeah, and then we could throw this into, you want to sell at where and buy at where. Because that's important too. Like even if you was to use this 20 simple moving average rule by itself, you always want to stay true to this one fundamental principle of technical analysis and trading. You want to sell at blank and buy at blank. Like you want to sell at where? Where do you want to typically sell at? So, I know and you typically want to buy here. You want to sell here and buy here at all times. Okay, well, maybe we didn't talk about it. Okay, yeah. Okay. Yeah, Ryan says sell at resistance, buy at support. Yeah, Richard said resistance. Yep, exactly. So then even when you use this 20 simple moving average rules, you still want to keep in mind that one fundamental core principle that governs all of your trading. You always want to remember to sell at resistance and buy at support. So then even when you see price test this 20 simple moving average, that functions as dynamic resistance. But even if you look left, we see structure, resistance to the left. We see this consolidation to the left. And like we said, price oftentimes likes to retrace to the midpoint of consolidation areas, which could function as resistance. But you still want to stay true to those fundamental rules, the core principle rule that governs every trade we execute. You always want to enter your sell at or near resistance, and you want to execute a buy at or near support. So yeah, that's pretty much the 20 simple moving average rule. That's how we use it. We just use it as a filter of what's to do next. So then, we keep going down. We can see that price continues falling lower, and the next opportunity may be right here in this area. As long as this 20 simple moving average is sloping downwards and price is beneath it, then we want to look for opportunities to sell.
Sell on a pullback.
So we'll look for opportunity to sell on a pullback. So then price pulls back, and then we're looking for an opportunity to eventually. Well, right now it's we can see here that it's starting to flatten out, and then we got this break to the upside. So then yeah, but right now we don't want to look for a sell based on the 20 simple moving average rule. We want to look for opportunities to buy. Now, let me just say this. This is just a rule that you can apply to your trading. But sometimes based on what we read from the price chart, we may violate these rules up here. And we may, and when I show you the strategy, you'll see what I'm talking about later. But, we have these rules right here. They're good rules to stick by, but sometimes you may deviate from these rules based on what you're interpreting from the price chart. Because remember, price is your most important indicator. And when it's all said and done, you're going to really base a lot of your decisions on what price is really telling you at that particular time. But this is just something to have just to keep you safe if you need a filter to keep you from over trading or from being on the wrong side of the market. You can use the 20 simple moving average. You can use the rules above to keep you on the right side of the market. So, but yeah, that's pretty much it. So then right now we're looking for a buying opportunity. That's what we'll primarily look for right now. And you'll look for the pullbacks, and then you'll get in on dips in price. And yeah, but all right. Are there any questions about this tool, the 20 simple moving average tool, before we move forward? If not, then we can definitely go back. We can exit this replay mode, and we're here back in real time. Okay. So I know Davina had a question. When price that was going downward then suddenly move upward, is that called resistance? Well, when price is going downward and it all of a sudden moves upward, then that means it hit support. It fell at support or a floor. So then it found support down here, and then it started moving upwards. So then that's what that means. Price was falling lower, and it hit a floor. It hit support. Remember, support is like a floor. It keeps you up. Like if you bounce a ball on the floor, that ball is eventually going to bounce up. And that's what happened with price. Price fell. It was like a ball that fell and hit a floor, and then we seen price bounce. So then the floor represents support. It's what supports you. It's what keeps you up.
That's where the buyers are.
Yeah, and that's where the buyers are. Like, I don't know if you heard Marvin in the background, but resistance is where, price hits a ceiling or some sort of, area, and then it starts falling from there. So then if you throw a ball up to the ceiling, that ball should bounce from that ceiling, especially if it's a bouncy ball. But
that's where the sellers are.
Yeah. So if you throw a ball up to the ceiling, which is resistance, that ball is eventually going to respond. It's going to fall lower. It's going to bounce. It's going to ricochet off that level. So then typically when we say you want to buy at support and sell at resistance, that's because you want to go where there's buyers already present. Like at support is where there's buyers. So then you want to buy where the buyers are. You want to stay on the side of the market where the market forces are.
And whenever there's resistance, that's where you know the sellers are positioned, and you want to typically sell at resistance
with the rest of sellers.
So then, does that make sense, Davina? Joe said, is 60-minute the best time frame, or can we use any other time frame? Well, yeah, you can use any time frame. This rule works on any time frame that that you apply. But what we're gonna like, the reason why I'm focusing on a 1 hour or 60-minute right now is because we're gonna teach you a strategy that's based on the 60-minute time frame that can help you guys tremendously. But yeah, you could use the simple moving average on the 1 hour. You can use it on a 4 hour. You can use it on a 15-minute. You can use it on any time frame, because one thing you have to understand is that the markets are fractal in nature. Like, you know, like I know a lot of people try to figure out what the best time frame is, but when you understand truly price and price action, it doesn't matter what time frame you use. You'll be able to make money on any time frame. Like, I know for me, I can make money on any time frame, even if it's the 1 minute time frame. I can make money on it because I understand price action, and I understand the rules you need to apply and how to apply them. So then, even with this 20 simple moving average rule, it applies for every single time frame, like from the daily, weekly, monthly, all the way down to the 1 minute and 30-second time frame. So then you could apply those same rules. But yes, it does work pretty well on the 1 hour. So then, if you want to stick to the 1 hour, just stick to the 1 hour. If you have time, if you're a day trader, and if you have time to trade the markets and sit in front of your charts, then I highly recommend that you do a lot of testing on a 1 hour. You'll typically find that you can make some good money doing that. But, once I share with you guys what we're going to share with you guys later, you guys will see why. But yeah. Okay. Are there any questions? Okay. So, but yeah, I guess from here we can just move on. So then we talked about the 20 simple moving average. And let me see if I want to introduce the next indicator now. Okay, yeah. Yeah, I may introduce it. And then right when I introduce this indicator, we're going to talk about the strategy, and I'm going to remove every indicator. And then I'm going to show you you'll see what I'm going to do. I want to take you systematically through everything so you can get an idea of why it may be beneficial to use indicators and why it may not be. But you'll see why once we show you these examples in the future, later on. But what we're going to introduce you guys now to is our next most important indicator, which some of you guys already know is our stochastics, which is the slow stochastics. So then what we're going to do now is add that particular indicator to our chart. So then we're going to go to indicators again, and then we're going to add the slows or the stochastics indicator. So let's do that right now. Where it says stochastics right here, we're just going to click it, and then it's going to add it to our chart. And we can keep it at 1433. They have it set at those settings or at those inputs as soon as you add that indicator. So then this is the default input, and you can just keep it at that particular input. But yeah, I guess, yeah. Did you want to? Yeah. I'll just briefly go over it for those of you guys that may not know. But as you can see, we just plotted the stochastic indicator at the bottom, and you can see this this plotting of this graph that's sort of cycling. It's oscillating up and down and up and down, and it's going back and forth between two levels. Now, what the stochastic really is in a nutshell, it's an oscillating indicator that really measures the rate of change, over time, or it's a measurement of momentum, or even how prices change and how prices close in relationship with one another. So then really, in a nutshell, it's really a momentum indicator. It measures the rate of change in price behavior, like how fast price moves, how prices close within certain time periods. So then we look at this indicator just to get an idea of market momentum, when markets have reached a certain point of either being overbought or oversold. And it can also help us to identify when would it be good moments to trade or execute a trade, and even at times even close a trade if you know how to read it to some degree.
Yeah.
But really, it's a measure of momentum. It's a momentum sort of oscillator, and it measures how price changes, the rate of price change over time, or the pace. It sort of reveals sort of like the pace and the momentum of price, and even in times the direction of price, the directionality of price. It can also indicate bias to some degree, but most importantly, it deals with momentum and sort of like the speed or the rate of price movement over a period of time.
Yeah. So then what we want to do is just talk about this particular stochastics indicator, and we're going to try to be as brief as we can. But just like Marvin said, what it does, it just shows you an indication of momentum. And yeah, I know Rob said, yeah, 14, 3, and 3. Yep, keep that as your default. 14, 3, and 3. That's your default. Or you could use 14, 3, and 1, but 14, 3, and 3 is much better because it's plots a more smoother line. So then that's the reason why we use 14, 3, and 3.
Yeah, and what the 14 means is like you're going to be taking data, like in that particular price point, you're going to be taking data from the previous 14 periods to get a figure for the current period or for the current time period. Yeah. So then let's say, you know, you're at this hour right here, which is what is this, the 1500 hour. Like we look down, it says May 1st, 2020, the 1500 hour, which of course in our time would be 3 p.m. Central or 4 p.m. Eastern. So then at this particular time, it would be taken into consideration the past 14 candlesticks or the past 14 periods. It would be analyzing this data, and there's a calculation behind it, but it would be taking data from how price closed within the past 14 candlesticks to sort of get a measurement, a stochastic reading for this particular candlestick during this period.
But yeah, well, there's the fast line and then the slow line. Fast lines uses, I think, the data from the 14, and then the slow line uses the 3. But
like it's a certain calculation.
Yeah, I know it's a certain calculation, but yeah, for the most part, what they're taking is the average price over a certain amount of candles, and that's what you're seeing plotted as far as momentum and pace. Based on that data or information. But what I wanted to share with you guys is that there's really 3 regions that you should be interested in. The first one on this stochastic indicator is right here above this purple line, which is where we have our 80 line. This is where 80 is, and then down here is where the 20 value is. We can look at the right and see the value of our stochastics from this right. So now let's just increase this right now.
But I think we can do that. It's the whole screen.
Yeah, we could. Let's see if we could. Is this right here? Yeah, let's increase this right here. Okay, so then we increased it just to let you guys see, you know, how this looks from this end. So then, what you see right here, this is 80 right here. You know, where this purple line ends. This is 80, and then this is 20 down here. And right in this area where we have the 80, this is what we call overbought territory. So then this is when we say that, you know, momentum is overbought, and there's a possibility that we could see price rotate. It doesn't mean
lower.
It does, it rotate lower. It doesn't mean we're going to see price rotate lower. But you can see that every time it hit the 80, we saw price cycle down. Every time it hit the 80, you know, we saw price cycle down. So then, you know, it hit 80, it was overbought, we saw price move down. So then this is what we call overbought territory. And then beneath this, or right below this, or right below the 20, is when we have price hitting oversold territory. So then this is called oversold territory. And we can see that whenever price reached oversold territory, that's when price went up. Hit oversold territory, momentum shifted up to the upside. Hit oversold territory, momentum shifted up. So then, you know, those are 2 important things you want to know. And then later on, not today, I'm going to show you another approach or strategy that you can use based on oversold and overbought on a daily and weekly time frame. But regardless, like the stochastics, they will show you when the market is overbought and oversold, and that can give you some intel or data on how to approach the markets that you're looking at right now, that particular asset that you're trying to trade.
Yeah, but you got to read those signals in relationship to price. I know right now, I know we're telling you about it's overbought and then it falls lower.
Yeah.
You know, it's oversold and it goes higher.
Yeah.
But you got to look at that in relationship with price.
Yeah,
and what the charts are showing you and what the trend is showing you. So
Yeah.
I know we're just showing you just the stochastic, and we got to enhance like the view so you can see these regions of the 80 and 20 that identify overbought and oversold. But really, you got to look at that in relationship with price.
With price, that's very important. Like what Marvin just said, because all indicators do, they just support what you're seeing based on price. Like they're a supporting cast. Like that's all they do is support and confirm what you think is going to happen. You should never trade solely off of these indicators. Like even the 20 simple moving average. Like all of these mathematical indicators, the purpose of them is to support a particular bias that you may be having based solely on price action and price behavior.
Yeah. So then what I would do, I would just pull up the price chart or just just tell them when it gets to overbought.
Okay, so then let's just do that now. So then let's go back and let's just see examples of this. So then we can see here that for one, price was bullish, right? But then when price went to, overbought territory or oversold, it tested this area. This could have been a buying opportunity right around here. You could have bought, made some. Price fell lower, right?
Yeah, but you see how even when it went to overbought, we saw that correction or that pullback.
Yeah, we saw price start falling down. So then as soon as it went from oversold to some degree.
And we know that when price is oversold, we'll see, we may see a shift in momentum upward.
Yeah. Now let me just say this, like I know right now we have both lines plotted, the fast line and the slow line. Like I know Marvin, he likes to have both of them, but I like to have primarily the slow line up there. But for the sake of just this exercise, we're just going to keep both of them up there. But typically what I would like to have is I like to remove the fast line and then just keep the slow line. But I'll show you how to do that later. But so then we see here that when it was overbought, we saw price slide down lower, right? Now price is oversold right here, and we see price push higher, right? It's overbought. Well, it's not overbought here, but it becomes overbought right here in this section. Price starts moving up, and it becomes oversold right here. We see a push down, but that doesn't mean anything, because we have to view everything in relation to price. But I hope it just shares you a point. Whenever you see, price overbought, it could mean that price is correcting in the opposite direction, or it could be supporting a move in the direction of the market. So then, but in this case, when we see overbought, especially in a strong upward trend, that means that price could be in the midst of a correction lower. And we see that right here. Price was overbought. But that overbought didn't mean that we should look for a sell. It just means that price is correcting, and then we need to look for an opportunity to buy. So I hope that makes sense. But yeah, you guys can see how this works with the stochastics. And when momentum is to the downside, we see that the perfect opportunities to enter trade was when the stochastics was in overbought territory up here. So then we can see that it was overbought here. This was the time to enter a short. And overbought right here. It was a time to enter short. We're going to do the vertical lines. And yeah, and it was, well, it wasn't overbought here. But, when we piece things together, you guys will understand how we use the stochastics. But I just wanted to share with you guys just simple rules that we apply. Now, I want to add something else to the mix. Like we know what overbought is whenever stochastic is above 80, and we know what oversold is whenever stochastic is above 20. And they can give you an idea of when price may be switching in a certain direction. But just like we share with you guys, even on that scalping method, one of the most important levels you can look at is the midpoint, which is the 50 level. So then just going to add this line right here, and we're going to modify it. And this is what we typically do. Let me just zoom in. Whenever price is above 50, this is what we would call our sell zone. Like we want to look for selling opportunities when the stochastics is at least above 50. This is a good filter to have. And whenever the stochastics is below 50, this is when we want to look for buying opportunities. This is what we would call our buy zone, you know, right around here when the stochastic is below 50. So then when it's below 50, you're looking for opportunities to buy, even if it hits this oversold area. It doesn't matter. You're looking for opportunities to potentially buy. Like that's if you're looking for a buying opportunity based on your price action. But right here, when it's above 50, that's your sell zone. You're primarily going to look for opportunities to sell. So then this is just a filter that you can use to be more accurate. Now, when I added this filter to my trading, it increased the accuracy of my trading by a good percentage. So then, you know, sometimes you want to live by those rules, and sometimes you would deviate from those rules. And we'll show you examples of that later. But for the most part, if you stick to this simple rule of looking for buying opportunities when the stochastic is at 50 based on price action and support and all that stuff, and you look for sell opportunities when price pulls back to a resistance, but you make sure the stochastic is at least above 50, then you'll do fairly well just from that alone, just from that rule by itself. So then, yeah, but yeah, I just wanted to point out that simple fact that we have a sell zone. The sell zone is when when stochastic is above 50, you want to look for opportunities to sell. Now, in this case right here, we don't want to look for opportunities to sell because momentum is to the upside. Price. Yeah, I was going to ask him a question. Like, why wouldn't we look to sell like in this part? Like we know that, let me just put in this vertical line right here so you guys can see. Or let's do it. Well, let's do this instead of that. Yeah, well, we could do this. We can even take this even further and just do, well, right around here, right? Okay. So then right here we know that. Okay, so then we see here how the stochastic is it's near overbought. You know, we see that it's shifting down into our sell zone. It's in the sell area up here because you remember we said whenever the stochastic is above 50, we should be looking for opportunities to sell. But why is it not important to sell now? Like why? Like what other indicators or what other things do we see on our chart that we may have just talked about today that will allow us to sort of know that it will not be a good time to sell? So then that's the question I want to ask you guys. Like, why wouldn't we sell? Even though the stochastics in the sell zone, why wouldn't we sell? Okay, I know Rob said the 20 moving average. Yeah, that's correct. Exactly. So then what about the 20 moving average? What about price? I guess, like, yeah, he is right. I think he already knows the answer, to that. But yeah. Okay, Richard said it's slope, right? Yeah, it's sloping upwards, right? The 20 simple moving average. And also price is above the 20 simple moving average. Yep. So the very fact that we see price above the 20 simple moving average and it's sloping above it means that even though price is in this sell zone, we don't want to look for a sell signal yet until if we get confirmation. Like that's the thing. Like we're not going to sell because in this condition we're not going to sell. Yeah, we're not going to sell unless we see a break of structure, unless we see some type of signal, or unless we see the 20 simple moving average start sloping downwards and moving downwards, and price goes beneath it. But in this particular case, when price is moving up, you want to see price stochastics get into this buy zone in order to buy. So then that's what you're waiting on. You're waiting for stochastics to get into this buy zone, and then that's when you're going to look for opportunities to pull the trigger or to cross the 50. Yeah, to cross the 50. Like it doesn't have to be deep within the buy zone, but as long as it crosses below this 50 or touches the 50 even, yeah, that could clue you in that there's a significant retracement and is a good time to buy. But you also have to look at other indicators as well and other things on your chart as well. You don't just blindly pull the trigger and shoot just because you see the stochastic has reached a certain point. You have to look at other factors as well. Yeah. Okay. Like for example, and during this section right here, let me just drag this right here, like right around here. like in this area right here, we see that stochastics was, oversold, but we're not looking to buy, mainly due to the fact that the 20 simple moving average is still sloping downwards. So then until the 20 simple moving average gets into our sell zone, because we know that since the 20 simple moving average is sloping downwards and price is mainly beneath it, we want to look for selling opportunities. So when does that happen? Right around
because it's kind of hard.
Yeah, right around here. Let me just I'm just gonna draw, place a circle right around this section is when you should be looking for an opportunity to sell. So then what you're going to do is you can draw a line. Let's change the color. Let's make this I'll say the blue, whatever, and we'll put it right when price crosses it, like right around here is when you need to look for a selling opportunity. If you look at the stochastics, price is crossed the 50, right around here, it tested the 50, and then entering our sell zone, right? And then right when it enters our sell zone, we know that, hey, okay, this is when we need to look for an opportunity to sell. The 20 simple moving average is still sloping downwards, price is beneath it. You want to look for opportunity to sell, so then you can sell and
yeah, you can sell,
see what happens,
and in alignment with the current trend and buys to the downside. Now, some people may be thinking, well, isn't it at this time we see that the price is above the 20 simple moving average? And that's what I'm trying to say. Like, there will be moments, brief moments in the trend that price will break maybe the 20 simple moving average, but the overall bias is still to the downside,
based on the slope. Like, as long as it's still sloping to the downside, the 20 simple moving average line is sloping to the downside, that lets you know that momentum and bias is still confirmed to be to the downside. So you still want to look for opportunities to sell. So then we see that in this case. Now, what's the next case? You see price went and fell lower down into oversold territory. We don't want to look to buy because, of course, we're still in a downtrend. 20 simple moving average is sloping up downwards, right? But we see that right here, we're in over sold territory, but we only want to look for a selling opportunity where when price starts to touch this 50 line and cross this 50 line. And where does that happen? Let's draw the blue line. That happens right around here, right? Well, let's, I think we can move it a little bit over. Right around there. Right around here. That's when it happens, right? And guess what happens? Price falls down. So then that's why I said, like, even with this filter, with the stochastics, it's very powerful. Once you understand directionality and price behavior and price momentum, you could just use these two indicators really by themselves, the 20 simple moving average and the stochastics, and do okay. But yeah. So then we still see that it's sloping downwards. Price is oversold here. But we're not going to enter a sell until price breaks this 50. We get a slight retest, but it doesn't test the 50, so we're not trading. It moves into oversold territory. And then right around here is when we're looking for a sell opportunity. But because we're assuming that price is still going to maintain its downward trend. But as you guys can see, price continues to break to the upside. And then we get an equal high, and then we see this 20 simple moving average begin to slope upwards. And at this time, that's when we change and pivot from our bias. Price is above it, 20 simple moving average is sloping upwards. So now we want to look for opportunities to buy.
Yeah. See, some people would blindly ignore what they see in price and say, well, oh, the stochastics at the 50 again. So then let me just go and just automatically pull the trigger and enter a sell without considering what's happening right here, that we're seeing a little bit of momentum to the upside. We're seeing the 20 simple moving average starting to slope upward. And plus, you want to wait for confirmation. And that's the thing.
Even with your entries.
Like, for your entries, you don't just want to just pull the trigger immediately. You still want to wait for confirmation signals to come up on your price to actually execute that sell position. There's certain signals, and we'll talk about that eventually later.
We could talk about it now. Like, let's just look at these examples right now. Remember what we talked about during last week. This is a simple confirmation strategy. Looking at a low, like in the downtrend, you'll be looking at a lower low, lower close candle. In the upward trend, you'll be looking for a higher high, higher close candle. So then let's just say for here in this example, right? We zoom in, and we see that price was pretty much consolidating for a while, right? And then you could say, okay, and you know, of course, we have, you know, stochastics at 50. You know, we're looking for a selling opportunity, but we don't want to pull the trigger yet until we see confirmation, until we see that trigger setup. So then what we could do is do something like this. Easily, like we can easily wait for price to break and close below the low of the previous candle. So in this case, when price gets here, we see that on the next, in this following candle, we didn't get a break and close below, but and then you can keep it right here if you want, you know, because it could create a range. But if you want to, you can just move it to this low right here, and you can say, okay, now what we need to see is for price to break and close below the low of the previous candle, and we did get that here. So then if you wanted to, you could enter your short on this trigger if you want to. But sometimes when price is in consolidation like this, we can just keep it like this, because as long as this range is defined, then price will have to break this low. But we can just look at price breaking the low of the previous candle, and that could be our trigger. And then we pull the trigger and we enter our short as soon as we see that. So then we'll be entering a short right around here at this candle, based on that rule of a lower low, lower close candle. Because we can see that the body of this candle closed below the low of the previous candle. So let's just look at the other example. So then we have this example right here where we're looking for a selling opportunity, and we get the low from this candle right here. This candle creates a low, but then we don't want to enter in yet. We need to wait for confirmation. So then we wait for the close of this candle right here. As soon as this candle closes, this is when you can enter your sell. So then you always want to wait for that confirmation before you pull the trigger. So then in the case that we had right here where momentum was shifting, you know, right here, price hit the 50, you know, right around here, we're in this area. We didn't see no lower low, lower close candle anyways. So then, you know, it doesn't matter, you know, you're not going to enter a sale because you don't see that trigger confirmation. And by the time price keeps pulling up, then that's when momentum shifts on the 20-simple moving average, is cycling upwards, and you would not have entered your sell anyways because you didn't see confirmation. Yeah, like we kept seeing, like as soon as, you know, it crossed, we kept seeing a higher closes, and it wasn't closing below, which would indicate and confirm a sell. Yeah, you didn't see a lower low, lower close. Yeah, so we saw consecutive higher closes, or just, you know, it was pretty much an inside candlestick like we have here, but we kept seeing it close higher. So then, of course, the momentum was changing, and we wouldn't look to sell because we didn't get that confirmation signal to sell. Yeah, and then at the time when price gets to this area, we're already seeing that the 20-simple moving average is sloping upwards. So then now we're abandoning and aborting our sell bias. We abandon that bias, and now we're looking for an opportunity to buy, but we need to wait for price to touch the 50. So then that's just simple rules that you guys can apply in your trading. Okay, yeah, Joe said he has to go. Yeah, we understand. This video is recorded, so you can definitely watch it later. But yeah, so then that's the basis and premise of the stochastics. That's how we pretty much use it. And if you use it often, you will find out that it does work. This filter does work, where, you know, we have the sell zone, buy zone, look for opportunities when price is crossing the 50. So are there any questions about the 20 simple moving average and the slow stochastics before we move forward? Okay. If not, then we can definitely move forward and talk about the other stuff that I want to talk about. But right now, what I want to do is remove everything now, because we're going to touch on something else now. We're going to talk about reading the price charts again. So let me delete everything, and or maybe I could just hide. Well, I could delete this stuff right here. But no, let me go back. Let me just hide it. Okay, and hide this right here. Hide this, because we're going to go back to this a little bit later. Okay. And what I'm going to do now, I'm going to remove these indicators. So then I'm going to start by removing or hiding this indicator. So we're going to hide this one. And yeah, well, we could just hide it. And let me just move this down right here. And we're also going to hide the moving average. And let me delete these lines right here. Because I think, you know, after today, you guys should be able to play some good trades after today, based on the stuff based on the stuff that we're sharing with you guys today. And it's not saying that you're going to be right all the time. You know, that's not what we're saying. But if you use some of the stuff we're going to teach you guys today, you guys should make some decent money trading the market. So then right now we have this naked chart. We don't have any indicators on it. We have no drawings on it or anything. And what we want to do is look at price action based on reading a price chart. And we're going to go through that exercise that we went through before on how to read a price chart properly. So then let me ask you guys a question. When the market is moving in an uptrend, what is price creating? It's creating higher highs and what? It's creating higher highs and higher lows. Yep, exactly. It's creating higher highs and higher lows. And when price is moving to the downside, it's creating lower lows and lower highs. Just remember this acronym. Uptrend, HHHL. That's all you need to remember. The downtrend, LLLH. You're going to live by those rules. Those are the rules you're going to live by. Now, I want to really emphasize, and I think we emphasized this even during the last webinar, the importance of reading a price chart properly. When we talk about reading a price chart, we're really referring to reading the price waves or the swings in price, defining the true waves and the true swings in price. So then if you can do that, then you're going to be better. And if you know how to read price and follow those rules, you're going to be better than 90% of traders out there. Our job is to make you pretty good and pretty decent. So then today, you know, we're going to teach you some simple stuff, some simple basic stuff that can give you an edge. But this is just the tip of the iceberg. But with the simple strategy that we're going to teach you guys today, you guys should do really well. But this is still simple stuff. But all right, so then let's just assume that okay, let's just try to draw on these price charts, right? Price waves. So let's start. Okay, what I'm going to do, I'm going to start right here. I'm going to okay, I'm trying to see how to do this. Okay, so then let's just draw in a few waves, and then we're going to look for trading opportunities later. So then in this particular strategy, what you want to do is go historically through price history, and you want to draw in your price waves. So then what we're going to do is do that first. And we're going to maybe, let's start. I haven't done this. We're going to assume that we're just going to maybe remove everything from here, right? Okay, so then right now what we're going to do, we're going to draw in our price waves based on our technical analysis. We're going to treat like this is the current time. When we enter the market, this is what we're seeing right here. We don't see anything to the right. So then we're trading without knowing what's going to happen. Let's just assume that. And let's just draw in these waves, right? So then we can start right here. Let's just start right here for the sake of time. So then if we start right here and let's draw in these waves, and we're going to create these waves, these lower lows, lower highs, and higher lows, and higher highs and higher lows. So then let's just start right here for the sake of time, right? Or we could start right here. So then we get this higher high right here, and then price falls lower and creates a lower low. So yeah, we get a lower high
and then we get a lower low right here, right? So then right now we see that price retraced and gave us a lower high. And then from here, what we'll do is we'll look for an opportunity for this to go even lower. And in this case right here, you can draw it right here if you want, but I'm just, for the sake of time, I'm just going to place it right here, right? So then we have this particular move to the downside right here, right? So then the next line obviously goes to here, right? So then price creates this lower high, and then we get a lower low again. Now let me ask you the question: where does the next line go? Does it go to A? Does it go to B right here, or does it go to C? Like this is A, this is B right here, and then this is C right here. Where do you think the next line would go? Okay, Brandon says C. Okay, we got A right here, we got B right here, and we got C. So then Brandon says C, Adam says C, Stuart says C. Well, let's see. Okay, so then, you know, we definitely don't want to do it here, because the reason why is because if you look at it right here, we do get a lower high, but this isn't considered a lower high yet, because we don't have an impulse leg that violates this low right here. So then that means that we could still be in the midst of a correction. So then whenever you see that, what you do is typically you place your highs and your lows right here. Like whenever you draw your lines, you should place your high, you should place a line at your low, and you should place a line at the high, which is right around here, right? So you know, we don't get a violation of either of those scenarios. We don't get a break of this low. So then we keep drawing it, and right here is when we get a violation of that low, right? I mean, of this high right here. We see price break and close above this high, and price is mainly just in consolidation right here. It's in this consolidated phase right here. So typically, like you can draw this out in a number of ways, but I know Stuart said B, and yeah, he's right. Yeah, and Richard, yeah, does Richard say it? Yeah, Stuart. Okay, yeah, I don't. Okay, yeah, I know. I see. Yeah, Richard said B too, and Adam said B. Yep. So then, really, it's B, right? So then Richard was right. Yeah, Richard, Adam, and Stuart is right. It's really B. So then that's when we see price break and close above this high right here, right? So then from there, what we're going to do, we're just going to keep drawing our particular lines. So then next we have this consolidation, and we can just draw it as one correction right here to this low. And then from here, where does price go? Does it go to A, or does it go to B up here? Or like, where would the next wave go? A or B? Now this is where it can get kind of tricky, but if you do see a violation and a break of the high, then you could draw it from here to here if you want, and then which is A, and then down here, and then you can push it up right here, right? So then this is what we see on this chart, right? We see price, you know, making this high up here. So then from here, and we can always adjust these lines right here. Like whenever you do create these waves, you can adjust the lines once you draw them. So then we have our high right here, and then we have our low right here. So then what happens? Price breaks the low. But typically, since this is only one candle, since this is a one candle pullback, we don't really count those. So then, you know, typically whenever we do see that, you just draw in one line from here all the way down to this low right here. You know, because this, you know, this is a one candle. Usually we want to see two candles
to constitute a pullback. But so right here we get this move to the downside. So then we now have to adjust our low right here, right? We have to adjust our low. And we can see that when price for all this period was trapped between this high and this low right here. It was trapped within this range between this high and this low. So then right here, you know, you don't have to do anything, you know, if you don't want to. But then all of a sudden, we get a break to the downside. Wait, as a matter of fact, no, let me, yeah, I shouldn't have drew this in anyways. Well, yeah, no, yeah, draw it in. Okay, so then, yeah, all of a sudden, you know, as price is moving, we get another break of this low, and right here, we see price. Oh wait, no, I was supposed to do this. I'm messing up. So then, yeah, okay. So as soon as we see a violation of this low right here, this is when we can draw this line. Like I don't know where my mind is going. So then we look at the highest point of this consolidation right here, and then you could draw the line from this high all the way down to this low right here, right? So then that's what we're seeing right here. So then in this case, we're bearish, and you know we want to look for opportunity to sell. And I'm going to show you how to put everything together in a little bit. But you can see that price created this lower high, and then where do we get the lower low? Right around here, right around here, right? So then now we're up to where we're normally, you know, where we're supposed to be, because let me modify these lines. Then we have the low right here, and we had our high right here, and then from there we move our low to here to this new low, and then we move our high right here, right? Okay, so now we have this empty space right here, and what we're going to do now is predict how price is going to move, or what we could see in the market. So then, you know, we're seeing this price action. Price is pretty much bearish. So then what we want to do is look at prior price history, and we want to say, okay, then if price does push to the upside, where could price find the next area of support or resistance? Because remember, we're still looking to sell. We want to sell at resistance and buy at support. And what we could do is look at these true swings in price. You know, we see that the closest swing is right here, which is, you know, where we want to look at. And we can define a zone if you wanted to, you know, from here to here, from this swing low right here to this swing low. So then we can define this zone. So then let's just do that right now. If we was to draw in a box to isolate the zone, we can just take it from this low right here all the way up to this low right here, where this high is right here from this candle. Let me just draw a line right here. So then we drew a zone between these two swing points right here, between this low right here and this low, since these are the two closest ones to where our low is. So then we can define that zone right here. So then what we're going to say is this, is that if price pushes into the zone, we want to look for an opportunity to sell, but we need to look for bearish confirmation. And actually it makes sense, because if you do your Fibonacci, that's probably about the 50% mark. But let's just stick to these rules. So then if we move up, okay, so then right here we're seeing price push above this particular level, right, or area. So then we could be seeing a change in price take place. But now our next level, like we didn't see a selling opportunity here. Our next level to sell or to look for any changes in price will be this level right here. right? So then what we want to do is identify this particular zone right here. So we can just drop box and just say, okay, maybe right around here, we're going to look for an opportunity to sell, to see if the sellers come in. Now, if we get a break of this high, then that means things are changing. So then let's just do that right now. Okay, so then now we got a break of this high. So then now the question is, do we want to look for opportunities to buy, or do we want to look for opportunities to sell right now? Remember, we saw a break and a violation of this high. So then do we want to look for opportunity? If it closed above A, then yes. So yeah, do we want to look for opportunity to buy or sell? So we get this push and break above this high. The question is, yes, you want to look for an opportunity to buy. Really, that's really what you want to do. You want to look for an opportunity to buy now. Now, we could add the 20 simple moving average, but for the sake of this exercise, I'm not going to add it because I want you guys to see something else. But right now, we see a violation of this high. Price created a higher high now. So then now what we need to look for is a higher low in order to sell. So then that's what we'll be looking for now, is a higher low.
Yeah. And, one thing I wanted to, share and add is that even with this break of this previous high up here, this was the true structure high that it had to break. And the fact that we got this strong move and the close above it lets us know that this is the new impulse move or impulse wave to the upside, that this is not just a corrective wave in a downward trend. But the fact that it violated this structure high up here, it broke and closed. And if you look at it, the type of move, like the type of volume and liquidity involved in pushing this higher, was a lot stronger than we did see previously, even in the impulse moves in this downward trend. You see this strong bullish response, this bullish reaction. There was strong buying and strong demand, and it pushed price even above this structural resistance area.
Yeah.
So then this is the new impulse. Like this impulse was defined when it broke and closed above here. So then right now we will be looking to actually buy this particular asset on a pullback. Since this is the impulse wave, we're not looking for a corrective wave or a retracement in order to buy this particular instrument and buy it to the upside.
Yeah, and this is why it's important to draw in your price waves correctly. It's very important. It's very key. Like even for this move right here, it's not a one-to-one measured move right here. As far as this move, like if you was to clone this line, it's a little bit larger than this cycle or this move lower. But what we may have is something that let me see if this is the case, because oftentimes you'll see the market becomes very, very harmonic in nature. Let me change the color. Let me change it to blue. But I'm just going to do this for the sake of this exercise. But from here to here, we try this. Well, it's not really a 2-3-6 move too. It's a little bit less than that. But we do have this particular move slide to the downside. So then, anyways, let's just move on. So then we're bullish now on this pair. And now what we have to do is wait for price to retrace. If it retraces down into this zone, then we're looking to buy. But if it keeps pushing up, then this is the next zone that we're looking to buy at. But let's see what happens. So then let's keep moving forward. So then you can see that price is responding to this swing high, this structure area right here. But most likely we probably wouldn't get in. So then price is now pushing higher. Okay, so then right now what we could do is just draw in these price waves. We can now draw it in from this low all the way up to this high right here, and then draw in another wave right here to this high, because we did get a higher high, and then from here you get a higher low and you get another higher high. Okay, So then, but yeah, but what we can see is that this zone is respected. This true swing high is respected. And what we could have did was enter a buy right around here, and you would have been pretty successful in that particular trading decision. Now, I'm doing all of this apart from the stochastics and the 20 symbol moving average. We're going to piece everything together in a little bit. But what I want you guys to understand is how to interpret what to do when you're solely relying on price, when you don't have any indicators, what to expect and how to trade. So then let's just move forward and see what happens. Okay. So then now we get this break to the downside, right? So then right now we can just draw in this new line from here to here. Now we're looking for an opportunity to what? Are we looking to buy or are we looking to sell now? Let me ask you guys this question. Price has made a lower low, and we have to wait for a lower what to form. Yeah, okay, Adam said sell. Yep, exactly. So then we'll be looking for an opportunity to sell on a pullback, but price will have to create a lower high. So let's just see what happens. We may get that lower high and we may not. Okay, so then we get that lower high right. We get that lower high right here, right? So I'll just modify this line right here, and then we get this lower high right here, and the trade may work or it may not work. It may continue going down, or we may see price continue going up. Yeah, but then this is where we typically want to sell, because what did price do? Price went up and it tested this structure area again. It pushed up, tested this area of structure. And actually, you can even take these swing highs right here, where these two highs are. You could draw a zone right here where these two highs are, right here. And you can see that price went up to this particular area right here. But let's remove that because we don't have a higher, low or lower low yet. But what we could do is just say, okay, right around here, we're looking for a selling opportunity, right here. So let's just see what happens, because price could turn and rotate and go the opposite direction. Let's see what happens. So price is going down, and it hits our low right here. If you had your target at the lows, it would have hit your take profit. Now, this is what we call the conservative target. So then, if you want to be accurate with your exits most of the time, then just target the previous low. So then in this case, if we would have entered a sell, a sell right here and targeted the previous low, we would have made money, right? But we can see here that price did look like it broke and closed below a little bit. We can take our lines again, which we should always do. Which we should always do. We should always take these lines and adjust them every single time we get that new line or new wave formed. But you could say, okay, if I enter a short here, I want to take my profit maybe right at where this pink line is or where the close of these candle bodies are. So then that's what you would do. You would enter your trade up here, place your stop few pips behind this zone right here, because the two swings tell you where that zone is. And all you have to do is place your stop a few pips behind this zone right here, and then just write this down maybe to these lows. And then, you would have made money on that position. So then right now we have two winners. We have a winner right here, and we have a winner right here. And really, if you could have did two winners if you would have entered the trade here. But we entered the trade here. It just gave us a decent pullback, and we met our target. So we have two winners right now, and eventually we're going to get a loser. But let's just keep trading, and let's just see what happens. So then from here, what we want to do is draw in our line. We have this right here. Price created this lower high, and then we get a slightly lower low that forms. So let's keep moving. So then price goes up. Now it's hitting our zone again,
And it actually broke above the zone. Remember, we had to modify the zones again. It actually broke above the low. I mean, above the high, the previous high. So then right now, we may want to look for an opportunity to, well, for this one right here, you'll give us some time. What you want to see is a decent extension beyond, because this downtrend could still be in play. But let's see what happens. I wouldn't enter anything now. Okay, so then we did get a break and close below, and price did retrace. So you know, if you did enter a buy, you would have entered a buy right around here where these two lows are, where this structure area is, right here. You see that, guys? You would have entered right where these two lows are, where these true swing lows are. Because what these true swings tell you is where the buyers and sellers are positioned in the market. So then let's just see what happens. Let's see if price pushes up. And as you can see, it does. And if you would have entered a buy here, you would have made money right here. So then we're seeing a continuation of the rules. Price created a higher high and a higher close. And then from there, we got a retracement. And now we got another higher high and higher close. But from here, what we would do is adjust our lines again. We got our low right here. And where our high was here, price broke above the high. But let's see how far price goes. Okay, so then we may get another pullback. Well, price is pushing up. Okay, so then price is pushing up now, and the next zone that we have to pay attention to is this high right here, this structural high. So then what we'll do next is draw in another zone right around this high right here. You know, I hope this is making sense. So then if we do get a buying opportunity, we want to look to buy right around here. And what we could do is look historically too to see if there's any confluence or confirmation. And you know, I believe we have this area right here, but you know, we don't really need that right now. What we have is this high right here that would provide a reason to go long. So then right now what we're going to do is wait for price to pull back and correct. So then as soon as we see this, what we can do is draw a line from, well, we should draw this line from here to here, and here to here, and another line to the upside right here, right? So then now we have this zone, and really you could draw between these two highs right here, between this high and then this high. Remember, the two closest highs to where price turn, you know, is where you should draw in that zone. So then what we will do is wait for price to retrace. Okay, so it's now in our zone. And then what we want to do is wait for that bullish confirmation. Let's see what happens. Price starts pushing higher. Okay, so right around here, we get the higher high and higher close candle. You see that? Right around here is where we get that higher high, higher close candle. So then this is where we will look for our buy, right around here, right at this candle. I hope that makes sense for you guys. Like this body of this candle closed above the high of this candle. This is when you're looking to buy. So right here, you can target the highs up here, or you can shoot for extended targets, whatever you decide to do. But let's see what happens. Okay, so then right here is where we may get stopped out, right? Which is bound to happen. What we see is that price went lower, and it looks like price may be turning to the downside. And let's modify these lines. I keep forgetting to modify these lines. Okay, so then we may be seeing a reversal, but what I'm going to do is change the color. I'm going to change this icon and change this first to red, and right around here. This is where we got stopped out. So we have 3 winners, right? 3 winning trades and 1 loser right here. Okay, but it looks like price is still respecting this low. but we want to wait to see if anything happens. Okay, so right now we get a break in violation of this low right here, right? Of this true swing low. So then right now we're going to look for an opportunity to sell. And guess where we're going to look for an opportunity to sell at? Right at this zone right here. Sometimes you'll use these same zones over and over and over again. So then we can just stretch this out a little bit further. And we're going to look for price to retrace up into this particular zone right here. So then let's just see what happens. Let's see if we can get that retracement. But for the most part, what we can do now is just drawing a line from this high to this low right now. So let's see what happens. So price is correcting and it's not there yet. Okay, so it touched it right here. It's right in our zone right here. This is when we're going to look for that bearish confirmation. So then when do we get it? Okay, we get it right here on this candle. So then right here, we get this lower low, lower close candle. And what we're going to do is enter a short right here. We're going to enter a sell right around here. And let's see what happens. Okay, so price, we want to see price hit at least this area, these lows right here. So let's see if we can get that. Okay, so it hit it. It got to the lows, and that was another winner. So pretty much that's how you apply this strategy in a nutshell. This is very simple to use and has a very, very high winning percentage. So then as soon as we get that move to the downside, then what we could do next, we're just going to adjust our lines. And this is going to be our new high right here. And our new low is going to be wherever this swing in price takes place. So then draw another line from here to here. And we can just keep it right here for now. But the next area that price is expected to respect is this zone right here. We see 3 consecutive times it touches this area. But you can do, remember, do the next, the closest two. So then we have these levels right here, and then we have this level up here. So then what I'm going to do is draw another box to identify that zone. So then let me place this line right here at this area right here. And then let me place another line right at this low right here. So then right within this zone is where we want to see price go to. I hope this makes sense. Let me know if this makes sense. If it doesn't, then we would constantly do this over and over again, maybe even on our next back to the basics session. But from here, we'll just wait for price to retrace up into this zone, and then we'll look for a selling opportunity. So let's see what happens. Okay, so price is in this zone again. It's testing the zone. Let's see what happens. Okay, so not right here is where we get the bearish confirmation right on this candle. So then right here is where we're entering a sell. And you know, if you enter the sell right here, you know, we don't got too much way to go, but you know, you could shoot for an extended target as well if you wanted to. You know, this is something that we taught before as far as using a fib inversion target, where you take your fib inversion tool, your Fibonacci extension tool, and you could just take it from the high of that correction to the low of that impulse leg, back up to the high again. And that would give you this area, this 127 area where you could target if you want to. But yeah, let's just see what happens. So we enter another sell right around here, and let's see what happens. Okay, price, boom. Well, it hits the low right here. We can close out our trade if we wanted to. But let's see if it goes to the 127. And it does. It hits the 127. So we could have got more. So then you see here, out of all these trades, you know, we have, you know, how many trades we placed? 1, 2, 3, 4, 5, 6. Out of 6 trades, we had 5 winners and 1 loser. Now, this works on any pair,
You can pretty practically use it on almost every time frame, even though the 1 hour works quite well. But you can see how this particular method works. If you stick to what we're sharing with you guys on this presentation, you'll make money. You know, you'll win more often than you lose. And it's based on learning how to read a price chart properly. These waves, these swings in price tell you where the turning points in the market will be. And all you have to do is define those zones and those areas where those swings and pivots take place and take trading opportunities right around those zones. It's just as simple as that. Yeah. So I was gonna say, so just imagine, even if you use, let's say, your moving average and your stochastic as filters along with this. Yeah. So then now we're going to add that to it as well, because there could have been a possibility for us to avoid this trade right here. There could have been, if we would have used our filter. Maybe the stochastic filter, we don't know. But just from using this by itself, you can see that we won more often than we lost. And you know, we'll make good money. You can make good money, and if you apply this on multiple pairs, then you know it makes a world of a difference. But let's just, and then also, this is without doing top-down analysis. That's one thing I wanted to point out. We didn't do any top-down analysis, but everything still worked properly, just from us drawing out these lines historically, just going in the past, reading the price chart before we even participated in trading. We identified where these zones were, and we knew where price was going to find some resistance and find some support. So that's why this is fundamental. Like when we say reading a price chart is very key, like it's very, very important. Now let's just add these 20 simple moving average lines. And let's just also add the stochastics as well. So then let me just drag this up. And then we're going to add the stochastics again, right? And let me see if we can add those the ones that we hid. Trying to, yeah, oops. Let's go back. We're going to add right here. We're going to open that up. Okay, right here and right there. Okay, I believe that's it. So yeah, we added everything. We added the buy zone and sell zones. We added all of that. So then right now what we're going to do is look at everything in relation to these indicators right here. So then let's look at this other opportunity right here. We entered a buy right here in this particular area. You look down, where was stochastics? It was, you know, below 50. Below 50. So let me just draw on the line to also reveal that. But yeah, right around here. Let's see. Yeah, I can just draw on a purple line. Stay consistent. Let's draw on this. But let's draw on this green line right here. So then right around here. For some reason it's, yeah, well, it's still below. Yeah, it's still below. Like, yeah, look at this right here. Yeah. Right here. But when it fell and gave the signal, yeah, that was the previous candle. Yeah, but yeah, that was a previous candle. But yeah, so then we can see that it's below 50 right here. You know, really we don't need to do this. But where was our next opportunity? Right here, we entered a short. Where was stochastic? It was above 50. They can't see on there. It's hard to see. Yeah, it was above 50. So then like right around here, we see that price was above 50, and this is where we entered our short. You see this green arrow right here? This is where we entered our short. So then on this trade right here, we see that stochastics was below 50, which agreed with, you know, what we're referring to. And yeah, also I wanted to point out, like in this case right here with the 20 simple moving average, we did see that the price was above it, but as you guys know, it was still sloping downwards. So then that supported that selling opportunity. Right here, we see that's the 20 simple moving average is sloping upwards. The stochastics is still below 50. You know, a buying opportunity. Price was also under the 20 simple moving average. So then that's what we were talking about. Like there are moments when you get that deviation from the rule. Yeah.
You know, as long as we see that the 20 simple moving average is sloping upward and it's in an upward trend, or that's what we're assuming it is, then you can still buy, because we're expecting price to eventually move above this 20 simple moving average and continue on upward. But you may get that, but you can see that in certain points, you know, you can see that the stochastic was under 50 when you bought, and you can see that it was above 50, you know, when you sold.
Yeah.
But what about this price up here where we got stopped out?
Yeah,
where was the stochastic then?
Yeah, it was right here. So then, based on that rule, where you know you want to look for opportunities to buy at or below 50, you can see that
It was.
you know, it was. We didn't violate our rules, which goes to show that, you know, sometimes you're going to have opportunities where you miss out, you know, where, you know, it doesn't work in your favor or for your good. And that's okay. You know, you could do everything right, meet the rules, and it still doesn't work perfectly for you. You're going to have losses. That's the cost of doing business and trading. But as long as you stay consistent with these rules, you're going to be right more times than you're wrong. So then in this case, stochastics was below 50. We entered a buy, but as you guys can see,
and the 20, yeah, I was going to say the 20 simple move average was sloping upwards.
But at this time, you know, because we didn't do top-down analysis, like if we would have did top-down analysis, we probably would have saw that this was a major level of resistance. But because we didn't do that, you know, we missed out on this trade, and that's okay. You know, that's the cost of doing business. But from here, we can see that momentum was changing. We had this break to the downside, and then right here we were looking for this retracement to this area. And then what happened? We entered our sell right around here. Stochastics was right here in this particular area right here. Overbought. You know, or above 50 at least. So then next time we enter a sell,
after that pullback,
was after this pullback. Where was stochastics? Above 50. So, you know, these rules still apply. Like, everything makes sense when you fit everything together. But if you combine what we show you with the price action and price chart, how to read a price chart, how to identify these zones where reversals will take place, and you apply with these filters with the 20 simple moving average, and then the stochastics filter, with stochastics being above 50 for a sell. Remember, our sell zone is above 50. Our buy zone is below 50. If you stay true to those rules and combine everything that we showed you guys today, you guys will do well. You guys will make great money trading the markets. So then that's pretty much it. We're going to do this more often so you guys can get familiar with it. But does this help you guys? Let me ask you guys this question. I know, you know, it could probably go over some of you guys' head, but does it make sense? Does it help you guys to some degree understand, you know, how this works? Yeah. Okay. So helpful. Yeah. Thanks, Rob. You know, like, we're called, like, the name of our course is Forex Anatomy. We want to show you guys how to view price at the anatomical level. Now, this is just the tip of the iceberg right here. But just this one approach right here could help you guys retire and never have to work for someone else again. And when we help you guys get funded, then it's going to make a world of a difference. You guys will see, you know, just the benefit of just being patient and waiting for these setups to occur. And this is just with one currency pair. Imagine just having a plethora of currency pairs, like 3 to 4 pairs that you would monitor and look at. So yeah. So how many pairs should we use initially? Well, you could use as many as you want. Like, my recommendation is that you have at least three currency pairs that you could use and apply with this approach.
And monitor.
Yeah, and monitor, like, what you want to do. Like, I know for us, like, this is what we could talk about as far as pairs. Like, for us, like, we recommend that you have a funding pair, a commodity-based pair, and one yen pair that you at least trade with. You know, so then in our case, like, okay, so let's just mark this down. You want to have a funding pair, funding currency pair. Then when we refer to a funding pair, that's something like the euro, USD, and
pound
Yeah,
USD.
the pound USD.
US dollar Swiss franc.
Yeah, and the US dollar Swiss franc. That's what I was about to say.
Like, yeah, just along those lines, you know.
Okay, so then that's what you call a funding currency.
Yeah, there's
pair.
more, you know, there's more funding, you know, currency pairs, but in a nutshell, it's, you know, some of your US dollar based or US dollar denominated, you know, currency pairs.
Yeah, so you want to pick one of those. And then the next is a commodity pair, which, you know, you guys should know like name a commodity pair, a currency pair that's tied to a commodity.
But, you
know, see if you guys remember. Okay, so Ryan said US dollar CAD. Okay, that's one. Which is what we're looking at right now. The Aussie USD is another one. And then what else do we have? Well, we have let's see, we have US dollar Nook. Yep, Chris put US dollar Nook. And we have NZD, USD, the Kiwi. Can't forget about that. And
the Mexican peso too.
Yeah, and the Mexican peso as well. Yep, that is right, the Mexican peso. Even though I don't really like trading the Mexican peso, I know Marvin, he likes trading it, but I don't really mess with it that much. Could we do US dollar Singaporean dollar too, right?
Or no, that's more of a
yeah. Okay, yeah, I don't know.
A carry. Okay. Secondary safe haven.
Okay, secondary safe carry. Okay, so then pick one of these. So we got a funding pair. Pick one commodity pair, and then we have a yen pair.
Yeah, yen pair are one that you can establish carry on.
Yeah. Yep, exactly.
Then, you know, you have, you know, your euro yen.
So we have the first one, US dollar, Japanese yen. It's the first.
Yeah.
Then we have euro, yen,
Aussie yen.
You know, GBP, JPY, Aussie yen. You know, all those yen pairs and yen crosses, pretty much. You know, NZD, JPY, CAD, JPY. You guys get it. But any of these pairs right here. So then, you know, what you could do is pick one funding pair, one commodity pair, and one yen pair. And that'll give you more than enough opportunities to make a lot of great money trading. So yeah, I just gave you guys something that would definitely change your life and help you guys from here on out. But this is just the tip of the iceberg. Like, this is just simple stuff. Like, there's stuff that me and Marvin that we're testing right now that will blow your mind. That we're working on right now, and we're seeing tremendous results. What we typically do, we go back years and we do back testing. And then after we do the back testing, we do the forward testing. And then there's stuff that we're going to reveal to you guys really, really soon that you guys, your mouth will drop. But and I know right now, like, I know I'm trying to ask how much to reveal. Like, I know for us, it took a lot for us to really come up with that information. But we may share with you guys in the near future. But what we may do for those who are interested in something that we're working on right now that would definitely have your mouth drop. Like, this right here is good. Like, with this money, with this method right here, you're better than 95% of traders. You'll make a lot of money. You'll become one of the elite traders with what we revealed to you today. But then there's other stuff that we can share with you guys that would definitely, you know, say, wow, this is incredible. So then we may touch on that stuff later, but I'm trying to figure out how to do it. You know, I'll let you guys know what we decide to do in the near future. It's just some stuff I'm praying over right now. But yeah, that's pretty much it. So are there any questions about anything that we talked about today before we close out for today? You know, what we revealed to you is pretty much the basis of the Forex anatomy strategy. You know, and it's all based on pretty much what we shared with you in month one. And that's why we said that month one's content is really enough just to really make a lot of money. But if you really want to really get some very powerful, high reward to risk trades, then there's other stuff that we're going to teach you guys later. But I guess that's it. Okay, so then we don't have any questions for today. what I would recommend for you guys to do is practice this stuff. Like just go over and over, practice this stuff, do back testing, look at certain currency pairs, look at the charts, even do that over the weekend, and try to see if this stuff works. Like try to draw in the waves and then look for those opportunities when price goes back to those zones that where we have the true swings in price take place. Remember, what we're identifying are the true swings that matter. All the other stuff in between doesn't matter. All these swings doesn't matter. The only ones that matter are the true swings that create the turns in price and the closes in price. But yeah, that's pretty much it, guys. But yeah. So this was good. It was a lot, but it was good. I really appreciate it. Okay, thank you, gentlemen. Okay, great. Ryan, thanks for coming. Thanks, Davina. Thanks, Rob. Yeah, thanks everyone for coming. Thanks, Adam, for coming. We really do appreciate you guys. Thanks, Oliver, for coming. But yeah, so then what we want you guys to do is practice this particular method and then use this method, because this is what we want you guys to apply, on your funded accounts. And if you do that, you guys will make some good money. So are there any questions about anything that we mentioned for today before we close out? I know we're coming to the end.
Yeah. One thing I would recommend, like, for you guys to do, log into your membership profile and look at some of the other past basic, webinars, because we're going to start moving, forward into some other topics. We're going to try to keep this, fundamentals, like, the essential building blocks. Even as we get newer members to come into, our program, we may have to review some of the earlier concepts, but just for your own learning, go back, rewatch this particular webinar. It'll be sent to you probably like within an hour or two. But watch this webinar again, go over some of the other past webinars and learn as much as you can, because this is really the building blocks. Like if your basics is really strong, if your foundation is strong, then you have all the knowledge you really need to be successful as a currency trader, not just in currencies, but even in all the other financial instruments and securities, like in stocks and ETFs and trading commodities and whatever instrument you're trying to trade. You'll be good at it with this basic knowledge that we've been sharing with you guys just on these Saturday sessions. So when you have time, just go and look over some of these past webinars and just kind of learn,
also, if this is helping you guys, and if you guys want to help us out by submitting like a testimonial, it could be written or even an audio or video testimonial. Please do that, because I know, a lot of people, they're suspicious anyways. A lot of people are thinking like, yeah, they probably don't know that much anyways. They're suspicious. But if this is really helping you guys out, like, you can help us out by submitting a testimonial. Like, we'll really appreciate it. If you could do a video, that would be even better. And the more you help us out, the more we're definitely going to help you guys out. Trust me. Like, there's still a lot that we could show you guys that will amaze you. But if you guys are getting benefit, please let us know. Please submit a testimonial or be willing to do that, and then that would help us out tremendously. If you feel this information is helping you guys. So but yeah. Okay, Ryan said thanks. I got you. I need a cut for the video. Yeah. Yeah.
Commission.
Yeah, you need a commission. Yeah. Yeah. But yeah, all right.
Also, commissions,
yeah, we'll talk about that later.
Okay.
Yeah, we'll talk about it, because we're trying to set that up right now as we speak. But yeah, I guess we don't have any questions. So you need a haircut. Oh, okay. I thought you meant a cut, like commission. Yeah, okay. Yeah, then I can do that. I send it to your email. Okay, yeah. Whenever you guys have time, you can do it. No pressure, no force. But if you guys can do that to help us out, then that would be great. That would be excellent. But that's it, guys. Thank you guys so much for coming to today's session. And like we say at the end of every single meeting, remember to always count your blessings, not your pips, because at the end of the day, even though you can make money and generate a lot of pips, that's not what's important. What's important is the fact that you're living, that you have family, that you're loved, and that you're being loved, that God loves us. That's most important. But that's it, guys. Stay safe out there, and we'll talk to you guys Most likely next week. We may have a back to the basics session next week. We'll let you guys know, or we may take a break.
Yeah.
But yeah,
Exactly. And we hear that the weather, it's pretty good this weekend. So if you can go out, get some fresh air. I know there's still the quarantine rules, but just enjoy.
but yeah, that's if you're in Chicago area. But yeah,
Yeah, but even in certain parts, like I know it's like 80 something
okay,
in the south.
yeah. All right, so yeah, that's it, guys. Thank you guys for coming, and we'll talk to you guys later. All right, stay blessed. All right, thanks, guys. All right, goodbye.